Gil, to get us started, give me two truths and a lie, please.
Okay, two truths and a lie. I have seven grandkids. I've driven a car over 160 miles an hour, and my brother survived the Leonard Skinner plane crash in 1974.
Oh my goodness. Those are amazing. Seven grandkids, 160 miles an hour, and your brother survived the Leonard Skinner plane crash. Holy cow. I don't think you've got seven grandkids.
You are correct. I
How many do you have?
have five right now, but one on the way.
Okay, nice. So 160, nice. What was the context there?
I had a Ford GT, the rear engine supercar, and had it out on the tollway and let it rip. And then, yeah, I have three stepbrothers that have all been in the concert business, and one of them was a roadie for Leonard Skinner and amongst many others, top name rock bands. And he was on the plane that crashed. There were six survivors. So anyhow, that's my two truths and a lie.
All right. Well, those were excellent. Well, it's good to see you again. Nick, this is our third conversation, so I'm grateful for that. And a lot
Yeah, me
going on
too.
in the world. What's top of mind for you right now?
Oh, just I'm in the investment business, so investments are kind of crazy right now. Stock market's been going up a bunch, and I think it's probably going to take a little breather. I think that expectations have gotten a little ahead of reality. People have gotten super enthusiastic about the possibility for lower interest rates, and I'm not so sure that's going to happen, at least not for a while. And that being the case, people are going to find out, I think, that they're a little over their skis. And so, anyway, that's kind of what's been top of mind for me.
Yeah.
How about you?
Same. I just read an article in the Wall Street Journal. It was sort of I don't know why it bothered me so much, but the author was saying, I don't know why people think the economy is so bad. It's going really well and inflation is less than it was before. And I thought to myself, well, stuff is just way more expensive. So inflation might be 3% versus 6, but doesn't mean
Yeah.
that the cost of things have come down.
Oh my gosh, inflation is terrible. I was noticing today, I had a poke bowl for lunch today, and I was noticing that the poke is pretty much the same price as it used to be, but the bowl's about a third smaller than what it used to be. So that's just another version of it. You still got a lot of really expensive products out there, and car prices are still kind of bonkers, although that's starting to settle down. Prices are starting to come down a little bit. Plywood was, I remember, crazy prices back 2 years ago. That seems to have settled down. So some of the aberrations of supply chain constrictions have normalized, but other types of items have not normalized. And food and the recent California change to the minimum wage really is going to be tough on California fast food restaurants in particular. With the low price point items, I think are really going to struggle. You're going to see a lot of businesses either shift to mechanical delivery of robots and the like if they have enough scale for that, or just go out of business entirely. So anyway, capitalism is not always very compatible with socialism, and I think we're going to see some issues of disjointedness come from that.
Are there levers that that the government could pull to reduce inflation, or is the horse out of the barn? What?
Well, what we've got is a multi-administration problem that dates back, in my sense of awareness, dates back to the Clinton administration, but it was the Bushes too. So even though I am a Republican and I do look more critically, I think, at Democrat administrations unfairly in some cases, but the Republicans are guilty of it too. And it really accelerated with the second Bush administration through the Obama administration, less so with Trump, but to some degree, and surely problematic with Biden, of them just printing money like crazy. You can make the argument that the 2008 financial crisis was made less scary by all the money that they printed, but then COVID just seemed to come out of nowhere, and I'm not so sure that the proper response was to restrict everybody and then give people money to sit at home and do nothing when they still have needs to go out and buy products. Where are the products going to come from the people who weren't making those products? That's a surefire way to kickstart inflation, and I don't know what the resolution of it is. I think ultimately we have to extract some of that liquidity from the economy in order to bring things back in line, but you're going to have a lot of gnashing of teeth, and politicians who try to get reelected by giving everybody money aren't going to like the reverse factor of that. So it's going to be tough to fix. If we can just stop generating more money and let things normalize, I think that's probably our best hope for an outcome.
Is that, there's obviously so much nuance in all this, but if you were talking to one of your clients and they were spending out of control and racking up all this debt and they weren't earning enough money to support it, is it you would say to them, "Hey, what are you doing? You need to take a big step
Well,
back."
but it's interesting you say that. So, maybe once every 5 years we lose a client. Uh, it'll happen once every 2 or 3 years because a client dies and we don't either want to do business with the offspring, or they want to spend the money and get out of debt or whatever. But we have clients once every 5 years who terminate us for one reason or another. Either they think our performance isn't high enough, or we didn't deal with this situation or that correctly. And we have hundreds of clients, so one every 5 years is not a big deal. But we did have a client who fired us recently because it was the culmination of after a discussion in which a divorcee, and I do business with the former husband and the wife, and she's just spending too much money. And she doesn't have any means of support other than the money that she got from the husband in their divorce, which is enough to support a reasonable lifestyle, but not new Porsches and traveling and treating all your friends to exotic destinations and the like. And I told her that I thought she was spending too much money. And within 4 months, I'm terminated, and she's gone to somebody else who's giving her a different opinion about it. So many people seek out advisors that will tell them what they want to hear. And, in the end, I felt like I was honest about it. And if I end up getting terminated, I've got plenty of new business. It's not a big deal, but it really was a wake up call. And I guess from a political standpoint, or to correlate it to politics, politicians all want to get reelected, just like I want to stay employed as everybody's advisor. You don't stay in office by giving people bad news. And in the end, back in 1870 or so, Alexis de Tocqueville, who was a French correspondent who was doing some work here in the U.S., wrote back home and said that the American Republic would survive until the common man could determine that he could vote himself prosperity out of the public treasury. And that's kind of where we are today. The common man votes people in who will give him benefits that are greater than what he's contributing to society. And it pretty much puts everybody else in a problem situation. And when you have the top 8% of the earners that are paying 42% of all the taxes, there's not that many of them to vote against such policy. And that's what perpetuates the problems that you have that normally crash the economies under the duress of giving the common man, all of the benefits that he's voting for. So I don't know whether we are there yet, but, seems as though we're certainly on that path to destruction.
Yeah, yeah, I think that that's fair to say. At what stage the doomsday clock is, if it's a couple of minutes to midnight, or if we got a little bit more time, or it's already passed. It seems like we're getting
The
pretty close.
good news is that we are still the world's reserve currency. And the Chinese, who seemed like they might be running neck and neck for that posture 2 or 3 years ago, they seem to be having a lot more financial problems than we're having. And I think they have jeopardized their ability to become the world's reserve currency. And as long as that's the case, we won't really have any problem printing more money, as long as people perceive that we'll be able to make good on our debts. And so far, that seems to be a believable scenario. And so I'm 60, I'll be 65 in September, so I don't know whether it'll happen during my lifetime or not. I would imagine that we won't have a meltdown of, some type of another debt crisis or a crisis of belief, if you will, during my lifetime. But I think it's going to be sooner or later, depending on what kind of politicians we elect.
How has your, for lack of a better term, advice or counsel changed since COVID to your clients, if it's changed at all?
It really hasn't changed. We are a permanent equity investor. We don't time the market. We don't add and subtract a lot. We do a little trimming around the edges. We do a lot of strategic giving. So we will accelerate advice to clients to be more generous in times that their returns are really high. That keeps us from having to sell positions and take capital gains taxes. We are very tax efficient and tax minded in the way we give advice. So rather than the traditional advice, which would be to rebalance, one of our rebalancing trends is that we call clients up and say, hey, I know your family foundation has this amount of money in it, or you have this in your donor advised fund, or you give $100,000 a year to your church. Maybe we should do that now. And so that's the way tax efficiency should operate. And that's the method that we manage money for. We have $1.7 billion under management, and we have over $700 million of unrealized gain. Those are just profits that have never been sold. And so that's what we're curating for. We are managing money for unrealized gain because it's tax-free at the death of the first spouse. It's really the currency of wealth building. And so that's what we pay particular attention to.
Speaking of paying attention to, what do you pay attention to? Are there certain economic data you look to? Is there a news channel that you pay attention to?
I read Barron's every Saturday. I love the publication. I think it offers me more mental stimulation than most anything else. I skim the Wall Street Journal every day, but I don't read all the articles. I look through the headlines and I pick out the headlines that I want to read the article about. But I don't really place a lot of credence in financial prognostication. I can give you a couple of data points that are so much more important than anybody's opinion, that if you stay focused on these things, you will have superior performance almost as a given. And the first data point is stocks go up in 81% of all marketplaces. So every 12-month time period for the past 75 years, stocks have produced a positive rate of return in 81% of all of those rolling 12-month time periods. Well, I can tell you the position that one should take based on that fact is buy stocks and don't ever liquidate. And a lot of people want to visit, they want to put a little bit of money in, then take a little money out. They try to turn it into a game of roulette where they're spinning the wheel. They're hoping that they land on, some color that they've bet on, but they're not really permanent participants. Well, those people are really not investors. An investor is somebody who buys something today with the hopes of selling it for more in the future. And that future is measured in decades, not in days. And there's significant tax advantages to choosing to do it that way because you pay taxes on the assets that you sell for a profit, and you don't pay taxes on assets that you don't sell for a profit, even up until death, in which all your taxes are forgiven. So when the odds are 81% that leaving it alone is going to generate a positive rate of return, and leaving it alone can also make the returns tax-free, there's one pattern of behavior that will be compensated better than all others, and that's to buy really high quality companies and don't ever sell them.
Appreciate that. So do you buy the actual individual stocks? Do you
Yes,
use?
we don't use mutual funds. We do a little bit of ETF investing because ETFs are low fee and are tax efficient. Mutual funds, by open-ended mutual funds, by their very structure, are not tax efficient and they are not low cost by and large. So that we just kick them out. They're not they don't fit our methodology. So we deconstruct the index in many cases. Our most popular strategy is a deconstructed index where we're building the portfolio to kind of match the S&P, but we try to do it with dividend income, and we do it in a super tax efficient manner. So my business is a wealth management business with tax consultation, intergenerational wealth transfer, charitable giving counseling, all of that as part of it. We have an asset management business tucked into it too, where we actually manage the portfolios, and we do that to crush the costs that a client would pay to a third party. We can't put them in a Fidelity mutual fund and have Fidelity charge 0.9%. In an 8% return world, I'm giving up double-digit percentages of my possible return, and I don't think that there's much hope that they're going to outperform over a long time period. So we break those indexes down, and we build portfolios with individual securities so that we can manage the charitable giving, we can take the strategic losses, we can manage the components. And the IRS has talked about negating it, but they still allow you to pick individual tax lots. So we'll own NVIDIA, which we have had since it was $40 a share, and the stock is almost $900 a share today. But we paid $40 for some, we paid $80 for some, we paid $200 for some. And we give the $80 shares away to charity. And then if we take a loss because we might have paid too much for it, we'll sell those shares and take a loss and then buy it back later. So it just gives the client a lot more options as to how they manage the nuances of their money when you own the components. And so that's how we tend to do it. So we run 9 separate strategies, and we mix and match those strategies based on cash flow characteristics, risk characteristics, what the client's trying to achieve. One of our strategies was up 49% last year. Another one was up, double digits, 12 or 13. But most of our strategies were up in the mid to high 20s last year. So that's very similar to returns that you would have found in a mutual fund, but lower cost and lower tax friction.
And do you have a sense of, obviously it's going to be, it's a relative thing, but you wrote a book, Foolish, about all the different expenses and the non-good things that investors get from brokerage accounts, like all the fees and the expenses and the loss.
It's partially the brokerage accounts, but it's partially feeding the ego desire of the investor too. So the book kind of goes into, yes, the system is stacked a little bit against the traditional investor. If they're taking an advice from a commissionable salesperson, you're going to get different advice than if somebody offered a more holistic solution. That's generally true. But investors want to feel like they're playing the game, and the way they play the game is very harmful to them. It generates far too much in tax friction, giving away the real opportunity to have charitable giving mixed with tax loss, strategic tax loss harvesting. You can add almost 2 percentage points to your return back to, in a 9% return world. If you can pick up 2 percentage points by tax managing and fee managing those results, that's way better results than you're going to get from actively managing the money. By the time you make some mistakes and you make some profits, you're not going to have 2 percentage points left. Whereas if you had done it a different way, it would have been a virtual certainty that you would have gotten that extra 2 percentage points. So it really challenges the thinking of the traditional way that an investor would approach money. People want to make money, but they think they can make a game out of it too and get an added emotional bonus to the entire activity. And it's quite an illusion, and it's self-destructive, and people are not critical thinking enough to evaluate their own performance in the proper context of what could have actually been, because we never know didn't happen unless we are critical thinkers about it. And so it really takes a more objective view to do it correctly.
I think that that's really powerful, that we want to make money, but we also want to have a little bit of fun doing it. And
That's
those
exactly right. Yeah. And we think that those are compatible when they are very incompatible. The things that we are motivated to do is us to buy too high, sell too low, ignore tax friction, and ignore pricing friction of the way the spreads between the bid and the ask work, the greater activity you have, the greater opportunity you have to mess it up. So anyway, we force people into a particular method, and then that reproduces the results over and over again. And a different type of investor is who would hire us. There are people who understand that they don't understand. They want to hire somebody who does understand. Fair enough. But what they really want is relief from the uncertainty of what it is they perceive that they should be doing. And they don't want to have to think about that. So they hire us to make that problem go away. And we have a mechanized process by which we do it behind the scenes at scale for large investors. So we're talking about, the $5 million kind of minimum investment, and our typical client is more like 25 million.
Understanding what you don't understand. I love
That's
that.
right. Yeah.
Love it. Great stuff. Well, Gil,
Yeah.
I think we're ready for that difference making tip. What do you have for us? Even though that was a good one.
Well, I think the difference making tip is that people should understand the cost of having something now. Now is a very expensive word. If you want a car that you can't afford and you want it now, I guarantee you're going to pay too much for it. If you want results in your portfolio that make you feel good about them and you want them now, I guarantee you're going to trail what could have happened if you had been more patient. So patience is a fantastic virtue that can be applied in many aspects of life. So anytime you're thinking that you're wanting something now, whatever that happens to be, whether it be a relationship, whether it be money, whether it be something self-affirming, whatever it is, if you want it now, it's going to be very hard to come by, and it's going to be very expensive to acquire, whether that's an emotional toll or a financial toll.
Well, I think that is great stuff. That definitely gets it. Come on.
Yeah.
Now is a very expensive word. You've given me a lot of really great lines and phrases and thoughts to chew on today, as you've
Well,
given
good.
everybody else. So thanks for coming back on, Gail. Where can people
Appreciate it.
learn more about you? How can people engage with you?
My firm is called Segment Wealth Management, so they can find me online. I've got many podcasts. I've got my book, Foolish, on Amazon. They can find it there. They can find us. We have a blog that we write and distribute. Nobody will ever follow up with anybody. It's a free financial tips line, if you will. So they can sign up for that at the segment for segmentwealthmanagement.com/blog.
Excellent. Well, if you enjoyed
Yeah.
as much as I did, show Gil your appreciation. Share today's show with a friend who also appreciates good ideas. Go to segmentwm.com. Check out everything that Gil's been talking about. Sign up for the blog and get your copy of Foolish on Amazon. We will link all of those in the notes of the show. Thanks again, Gil.
Appreciate it. Thank you.
Until next time, a friendly reminder, never going to be anybody more interested in your financial success than you are. So act accordingly.